Paul and Rachel Dager for all of their support and helping us bring the information we'll share with you today to all of you. Joining me is my partner in crime, Will Creech. So we'll do a couple of introductions so you know who we are, and then we'll get started on the content. We're going to try to leave a good 10 to 15 minutes for question and answer. So if I think you want, you can submit them through the chat. Paul's going to be monitoring them, or feel free toward the end if you want to unmute and jump in. We like this to be, very interactive. So with that, I'm David Solis. I'm the business advisory consultant here at First Citizens Bank. I'm completing my 30th year in the world of financial services and kind of always been in this space of working with clients, predominantly business owners, in both what we refer to as the wealth space and within the business and commercial banking space. Will?
Hey, good afternoon, everyone. My name is Will Creech. I'm a wealth planning strategist here at First Citizens. Been in the industry about 10 years. Have my master's in financial planning from the University of Georgia. Certified financial planner. So fancy way of saying I've had all my shots and passed all my tests. So my role is to look at clients' financial picture holistically and kind of organize everything from their estate planning to their investments to their businesses, and take a holistic picture of that and stress test it against kind of the long term, right? So making sure goals are being accounted for, risks are being accounted for, looking at everything holistically, stress testing it, and synthesizing it into one report, making sure that your financial goals and objectives are being completed along the way.
Thanks, Will. And so I think Will's had some experience in the past working with you folks and having attended a conference that was hosted up in Tennessee at one point. So it's feasible we may be with you guys in the spring at the next conference. But let's dive right into what we refer to as business advisory. And as Paul mentioned, the theme today is this importance of integrated personal and business planning. So a little bit about First Citizens. We are a Raleigh headquartered bank here in North Carolina. Not only top 20, I think we've cracked the top 14. We've seen tremendous growth here. The expertise First Citizens has in the acquisition of new assets and very patiently and thoughtfully growing the company has been very impressive. And unique, I think, to First Citizens is that it is the largest family-controlled bank in the United States. So still family-owned, and now with its fourth generation of leadership in the bank. So this idea of how you build a business and get it to last for the long term or transition that business, which is a big part of what we'll talk about today, is really in the DNA of First Citizens. From a wealth perspective, First Citizens Wealth is a boutique wealth shop. It's been around for about 11 years, and it's a comprehensive wealth offering. So with $52 billion in assets covering 30 states, we offer everything from deep wealth planning, which is one of the roles that Will plays here for us, asset management, private banking, personal and institutional trust work, investor services, and then, of course, what we'll talk about today, business advisory. So what we like to say to our business owners is if you have something you think you need help with in the financial world, it's very likely First Citizens is going to be able to help. So today's agenda is really, we're going to what we call the current state of business owner preparedness. There's some third-party organizations out there that survey every few years how business owners are feeling about their level of preparedness when it comes to both their personal and business situation. We'll talk about what we affectionately refer to as the three legs of the stool, as you know, in the world of business transition preparedness, expectations and experience. And what we mean by that is we would love to be helping members of MBNA. We think we can do this better than our competition. That said, we truly want you to embrace this process, whether that's with us or someone else. It's just important to do that because we really want all of these businesses to last and to continue on. And so we want you to understand what you should expect from a process, like the one we'll cover today and the experience that should come along with that. And then we're going to do a quick case study, and then we'll open it up for questions and answers. So the business transition statistics, there are 32 million privately held companies in the United States. 75% of those that employ people, so 75% of employer business owners would like to transition over the next decade. Okay. That's 4.5 million companies and $14 trillion in wealth. So back to the fact that we don't want to see these companies disappear, and good planning ensures their longevity. So 14 trillion is a significant number of wealth that's going to transfer over the next decade. We want to make sure that that stays intact. Now, interestingly, while 75% of employer business owners would like to transition over the next decade, the reality is that 100% of business owners are going to transition at some point. We're all going to transition. And I think for part of the work that you guys do in the monument space, this hits home, right? The unfortunate reality is that 50% of those transitions are not voluntary. So you either face one of what we call the 5 Ds. You're either going to face death, disability, divorce, distress, financial distress potentially, or other disagreements in a business where maybe they're partnerships or families working together. And so we want to plan to avoid the involuntary transition, if you will. So an interesting statistic is that 12 months after transitioning out of a business, 75% of those business owners profoundly regret it. And so the biggest driver behind that is the second statistic that you see. In 2013, the survey showed that 96% of business owners had no plan for what to do after they sold their business. And the biggest driver of that regret is they don't know what to do with their time. These businesses that you all run are your identity. It's how you spend your time. You have relationships with your coworkers, employees, with your community. And so it's so important to understand what happens at some point down the road, whether you want to get out of this business or whether you want to pass it down. What will you do with your time? Now, fortunately, that's decreased from 96% to 51% over the last decade. And that's really due to the fact that there are more and more institutions out there, whether they are financial institutions or other professional advisors that are talking about this subject with their clients. So accountants, attorneys, et cetera. Now, 49% of business owners showed that they had done no planning, not just what am I going to do if I sold this business or was no longer in this business, but no planning, no retirement planning, no estate planning. So 30% said that they had an updated estate plan, and 24% said that they have a will. So the inverse of that is 70% don't have an updated estate plan, and 76% of them do not have a will. And so will, in the
Yeah,
work you do with clients every day, talk a little bit about the pitfalls and concerns of not having these things in place in this last column.
yeah, absolutely. This third vertical is what I think hits home the most and is the most neglected. Um, so going back to that 100% of business owners will transition at some point. So that's either vertically or horizontally, right? So either in your lifetime or after it. And not having a will or not having an updated estate plan either reduces or eliminates your control over what happens to your business at that point. So the thing about not having a will at all is the state that you're domiciled in does have a plan for you, and they're going to pass the assets by law. And I can tell you, not many of the clients I've worked with over my time would agree with the way that the state divvies up their assets if they have no will in place at all. For the ones who haven't updated, so typically we find clients create their will when children are born, and they haven't been updated since. So there's been situations where ex-spouses have been named as in those kind of documents, and that also goes to life insurance and retirement plans that haven't been looked at in a long time, where we have beneficiaries who we don't want anymore, haven't been looked at. But you could very well be passing control of your business to someone who, number one, might not be prepared, or number two, might not know what to do with this business. So this part is critical, and an estate plan should be reviewed at least every 5 to 7 years, and that's if things are going normal and everything's fine. But also after any big life event, whether it be one of these 5 Ds, a death in the family, a disability, a divorce, at that point they should be updated as well. So this part is critical. I find a lot of clients neglect this piece, and it's very important to even the longevity of your business to make sure this part's kept up. The other part that I would lump in here is buy sell agreements. So typically, if you have a business partner, a buy sell agreement is something that's put in place when a business is formed. Um, and I've found about probably 75% of the time they're not looked at again. And then one of these 5 Ds come up, and we're looking at either a formula that evaluates your business at a very low rate, which allows your business partner to buy it out at a very low rate, or it hasn't been updated since the kids have been born or the marriage. So if something happens to your business partner, now all of a sudden you're in business with a business partner's child or spouse that has no idea what they're doing. So it can create a lot of distress on the business. So this is one area that I think needs a lot of focus, and some small tweaks can go a long way.
That's right. And so the way we try to eat this elephant one bite at a time is really by thinking about these three legs of the stool, right? So one is personal, one is financial, and one is the business itself. So on the personal leg of that stool, back to that statistic about people really regretting having sold their business, one of the processes that steps in the process that we go through with our clients is to really take a look at what life looks like after the fact. Who are you outside the business? What are your goals? How are you going to spend your time? And it's really important to have a written plan. There's that quote of having a good plan that you execute perfectly is better than the perfect plan that you execute poorly. So we really take clients through this process and have a lot of discussion about what does life after sale look like? Are you traveling? Are you golfing? Are you spending time with grandchildren? Are you charitable? Are you volunteering? How do you spend that time? And then that transitions to this second leg of the financial picture, because to do all of these things that we think about on the personal side, right? It takes financial resources to do those things. And so we take a look at the current net worth statement, which is inclusive of the business itself. And we'll talk about how do we determine business valuation. So I have the financial resources to accomplish those personal goals and vision? What is that number? And ultimately, we refer to that as a wealth gap. Is there potentially a gap between what you want to accomplish and the resources that you have to do it? We find that for most of our business owners in reviewing their personal financial statements, 70 to 90+% of their net worth is the value of the business. So how is that going to be monetized? And there's several ways to look at that. And then how do you minimize both income and estate taxes in that process? Because a business is worth what it's worth, net of debt, net of taxes, net of fees. So lastly, the third leg, which is identifying what we refer to as a value gap. So we go through a process that we're going to get into more depth here in a second on about, is the business as attractive as it could be, giving the client a sense of what it's worth through this process that we show. And how are you going to actually transition this, and how will that transition impact goals? And a lot of that revolves around, is it an inside transition to a family member, to a partner, to a management team, to employees, or is that an external sale? And there are different ways in which those external sales can take place. Sometimes we see clients doing private equity for very particular reasons. Sometimes we see clients doing an outright sale to a strategic buyer. So we're going to talk more about these three things, but those are the three legs of the stool that we take people through in terms of the process that we'll cover. When we think about the value gap, which is really related to what is your business worth versus what do we think it could be worth? What's a good kind of analog to that?
Yeah, that's a great question. It's just like when you're going to get an appraisal on your house, right? We go around and look for houses in the neighborhood that are similar, and find those comps. And we can do the same thing with your business, whether it be regionally, tied to industry, tied to size. Go out and find similar businesses that have sold, and what those measurements are, and find ones that are like your business that kind of gives us a glimpse of what the market rate would look like.
Right. So we're not a capital markets group. We're a planning group that really goes through making sure that whatever the objectives and goals of our clients are, that we're going to build the structures and the approaches to make sure that those things actually happen the way that they want. And then we partner, which we'll talk about in a second, with the other advisors to make those things come to fruition. So the process, whether again it's with us, which we hope it will be, if this is something that you feel you need to embark on, or whether it's someone else, this is really what you should be thinking about from a process expectation perspective. So defining those goals and that vision in great detail, quantifying business and personal resources. So back to what's the business worth, and is there a value gap with what it's worth today and what other businesses like yours are selling for? And then what's the plan to drive the value of that business to get you as much for that business as possible? And then again, between your personal vision and goals and the resources you have or will need to accomplish those, is there a wealth gap? So that's this retirement analysis. And it's about those assets and how they're going to endure and last over many, many, many years for you and your family. And then the next step that we get to after we've gone through, those two first pieces is really before thinking too in depth about transitions and other, we want to get to very basic risk protection reviews and implement some of those things because heaven forbid something happens tomorrow or, a week or a month or a year from now, we want to make sure everything's buttoned up now and then begin the process of planning for what we believe will be success for you and your business. Will, some of the areas that we focus on when it comes to kind of risk protections?
Yeah, absolutely. So first off, we talked about buy-sell agreements and making sure your estate plan is updated, but also is that proper succession outlined, right? Is there a management group? Is there a family member who can step in and act on your behalf if you're not able to, whether it be a death or disability? Is your current business structure the best from a tax efficient standpoint, to a protecting your asset standpoint? Is the do you own real estate that's in a separate LLC? Is it being rented back for the correct rates? Another one is personal and business assets being commingled. So quick story here. Clients in North Carolina had all their vehicles, cars in the business that they're using personally, sent their child down to the University of Alabama. Child got in a car wreck. Insurance company came back and said, well, your North Carolina based business, were they doing a delivery? And the business owner said, no, that's just, their car. And they actually got dropped by their property casualty carrier because they had a business vehicle, not on business time, doing personal things. So we take a look at all that stuff to make sure that's all lined up. We take a look at your business property and casualty insurance as well as your personal side umbrella insurance. And also, like with the estate plan, do you have the proper trust set up? Can they handle these types of assets? Do you have life insurance in place? There's numerous different strategies to look at, but I like to say it. You spent your life building this financial castle, right? Your business, that's your main asset. We just want to check the moat, make sure it's deep enough or it's adequate enough to protect that castle.
I was going to say roll tide, but that didn't seem appropriate given the story you just told. All right. So we've now got our clients protected. Everybody feels good about that. We know what the business continuation plan is. We've reviewed buy-sell agreements. We know they're properly funded. Flash forward to the next step, and it's okay. So we understand if there's a wealth or value gap, we've got you protected. What is the intention ultimately? Now that we've shown you some comparables, is there an opportunity to really grow the value of the business? Some of our clients are acquisitive. Some of our clients want to invest in the business. They look at automation. They look at ways to expand. They get pretty excited going through this process because, again, we'll detail it with a little more clarity here in a second, but they get really invigorated sometimes coming out of this, and they really want to embark on a growth trajectory. In some cases, our clients are ready to transition. There's no wealth gap. The value of the business is looking fantastic, which, by the way, the right time to sell a business, if that's something that someone's interested in, because we can't predict economic cycles or interest rate environments. It's when you have all of this work done and you know your number and you know that the sale net of debt, taxes, and fees is going to get you that number, because there's never really a perfect time. So sometimes our clients are ready to move forward with this idea of transition. So then we start looking at the different strategies related to what they want to do with respect to that transition. Is it an inside sale or an outside sale? Inside sales have their own unique aspects, complications, challenges, as do outside sales. One tends to yield a higher number than the other. The outside sale tends to get more than the inside sale. How you finance that inside sale such that there's liquidity and giving you the assets as a business owner that you need to accomplish the things you want to. Some of our clients want a very clean break, even though they're transitioning it to the children. They expect them to go get their own financing to transact that, transition. So we go through all of those different scenarios and get to a place where our clients are clear, and that the family and other stakeholders are clear, which we'll talk about here in a moment. And so after going through this process, back to the theme of our webinar today, we deliver an integrated personal and business plan covering estate, retirement, and how that business is going to transition. So we have a proprietary tool that we built here called GoalView. It's our business assessment process, and we go through 8 areas of personal preparedness, 8 value drivers, and we take a look at a few years of financials, normalizing for any, realities of what we're seeing in those profit and loss statements and tax returns, etc. And it's a couple-hour interview that we go through, and again, clients really seem to get excited because it's rare that you get to talk about your business in this way. So I'm going to let Will talk a little bit about that as he's the person on point amongst our other planners, which we have a pretty big deep bench of planners that
Oh,
takes our clients through this process. I think we've hit on some of these areas of personal preparedness. Will?
yep. I'm sorry, I lost you for a second. Can you hear me?
Yep. You want to hit on maybe a few of these personal preparedness areas we haven't hit on yet?
Yeah. So absolutely. Actually going to start with the financials, the vertical on the right. So we start the process by collecting 3 years of tax returns on the front end and kind of diving and looking for trends. So we use those to come up with a number called EBITDA, which is earnings before interest, taxes, depreciation, and amortization. So we get that number, and then we find a multiple of that to come up with a informal value of your business. So the way we get to that multiple is by going through this interview process that David had mentioned, but kind of hitting on some of the key areas. We've kind of touched on estate planning, and personal vision, kind of what you see for yourself. And I think that ties hand in hand with life after sale. And please don't laugh at me when I say this, but people transition their business and realize that in 50 years they haven't spent that much time with their spouse ever, right? So it goes both ways, husband and wife. It's like, you're at the house a lot more. And I hear golf and spending time with the grandkids as the number one things to do, but it rains sometimes and the kids go to school. So we want to focus on a lot of that life after sale, and also you got to take into account that business is part of your identity, right? You've been growing it for years. Your name's typically on the sign. You're the big sponsor of the golf tournament or the Ducks Unlimited banquet. So when that's gone, that's something that you've got to account for, right? So switching gears into the retirement planning, typically the business is the bulk of business owners' balance sheets. So that's an asset that typically needs to be monetized. So switching from retirement into investment allocation, how do we take this concentrated asset and turn it into something that can provide you income and provide for your goals in retirement, whether that be stocks, equity, bond, investing in other businesses, what have you, coming up with a diversified portfolio that matches your lifestyle and your expectations in retirement. Owner phase out's a big one. I find it rare that clients just like to close the door, walk out, and be done. So typically, it's, maybe I want to start taking Fridays off. Maybe I want to start working 3 days a week, and allowing you to do that on your timeline, however that looks like personally for you. We touched on asset protection, stakeholders. So um, there are situations where if it's a family business, there are siblings or relatives that have ownership of this business, that this business is providing an income for them. So if the business is sold, have we thought about that? Have we thought about the impacts of all the stakeholders of the business, whether it be children who are working for the business, what have you, taking that into account. Switching from the personal side to the business side, a couple areas to focus on is independence from owner. Frequently find that the question we ask is if you go out of the country on a 2 week cruise, is the business going to be exactly like you left it when you come back? And a lot of times we find the answer is no. So it's okay. How do we start making that happen, right? How do we start automating processes? How do we start documenting sales opportunities? So being able to create that separation from you as a business owner and your business so that it can run without you being there on a daily basis. Diversified customer base. I like this one in diversified customer and diversified supplier, right? So does 80% of your business come from 20% of your consumers? Does 80% of your supplies come from one supplier, or 20% of your suppliers? So how can we look at making sure that we're diversified from a customer and a supplier base to protect the business so we don't see any kind of peaks or valleys depending on others? Customer satisfaction. So with this one, I usually hear people say, well, I know my clients are happy because I'm getting repeat business, or I get good Google reviews, right? But are we surveying these customers to hear what they're actually saying on a more anonymized basis? So we can actually hear questions, concerns, engaging their actual happiness. And these are all things that prospective buyers are going to want to see and hear and know. But the flip side of that is sometimes we start to lose people here. They're like, oh, well, I'm just going to transition the business to the next generation. The business is working fine. I'm just handing over the keys. Well, that is all well and good, but we want to check under the hood and see if there are ways that we can make things a little bit more efficient and streamlined and set that next generation up for the most success that they can have. So like David said, there's 8 components to each. We go in each 8 in a very detailed way, and we come out and look for the best 3 to 4 areas we can improve quickly and close that wealth gap and close that value gap.
Yeah, I think strength in these areas, to Will's point, is what a buyer is looking for. But whether the plan is to sell this business you have at some point, or transition it, or even grow it, going through this process to really think about, I think every one of these areas, we probably go through 5 to 7 kind of questions about each. It's self-scoring on a particular scale. There's an output that we provide, scoring in these different areas to review and think about. But again, how can we make revenue more predictable? Are there recurring revenue opportunities? Are we ready to upgrade that operating systems, to drive more business, whether that's automation and marketing efforts, or making sure that we're not going to lose any critical employees, or how we're growing our talent, to Will's point, to be able to step away from that business and have that independence. So it's a great process to go through, and we find that our clients get really energized from it. So ultimately, there are so many entities, people, that you could transfer a business to. And again, I want to emphasize that this process is not for people who are ready to transition. As a matter of fact, planning takes time. So we're really here to help businesses no matter what stage they're in. We think it's a great investment, whether you're, you know, 10, 15 years away from, but thinking with the end in mind. But certainly if you're somewhere between 3 to 5 years of really thinking about transitioning, it's important to get this process going. But again, there's so many different entities and people you could transfer business to, and they're in what seemingly looks like an innumerable number of methodologies to do that. The one that's right for any particular business owner is unknown until the process begins and all the dialogue is had. And typically, you're going to draw a little from each of these blue boxes to really figure out what the right process is. So we share this with you because, yes, there is some complexity to this process, but it's nothing that we don't have the expertise to help people walk through, and particularly when we do that in partnership with the other advisors that you likely are leveraging today. So to that point, when you think about First Citizens, maybe some of you are banking with us today, but I'm sure you all have banking relationships. We and the banker, the wealth consultant in our organization, and the banker act as the two quarterbacks for our client relationships. The banker providing the capital, cash management, growth enablement that our business owners need, where the wealth consultants focused in on how do we help you through this business succession process, thinking with the end in mind, retirement, estate, et cetera. And then we don't disintermediate those other advisors, CPAs, attorneys. We work very closely with them. I was just up at a meeting outside of Hickory, North Carolina, with a business owner, and we're making an introduction to an estate planning attorney. He has a corporate attorney. We're working closely with the CPA, gathering the financial documents for the different businesses that he owns, as well as the personal stuff to begin this process. So we work in concert. It's tough to get attorneys these days, and we'll explain to you why with some of the tax changes that are coming down the road. We found some of our clients really benefit from introductions to business coaches, business consultants. It was an event in Garner, North Carolina that we were hosting recently, and one of the business owners came up to me after the fact when we spoke about this particular area of business coaches, and they said, we had somebody come into the business. This will be our third year working with them, and they've helped their business focusing on strategic priorities, accountability, scorecarding, all kinds of areas, and they've helped that business go from 9 million a year in revenue to 25 million in revenue just over that time period. So they can be very positive. And then ultimately, if somebody's looking at an outside sale, we can help make introductions and be at the table with our clients when it comes to M&A folks, private equity folks, or business brokers, depending on the size of the business and the strategy that we've determined the client wants to implement. So again, coming out of this process, we would expect any one of our clients to receive the following. It's certainly what we at First Citizens are going to deliver. The integrated plan, the informal business valuation, and that benchmarking, i.e. that value gap, asset protection strategies, reviews of the buy-sell agreements, how you're going to transition the business, how we're going to minimize taxes, both income and estate, making sure there's a clear plan on life after sale, and how do we bring those stakeholders to the table so that they have awareness of these plans. These are sensitive topics. We find it's not a good thing for employees to find out that people are thinking about transitioning. People get nervous. So we're sensitive to that, and we use a lot of discretion and work at the client's pace around when they want to be communicating things and what they want to have communicated. There should be legacy creation processes and ideas that come out of this, and then generational planning. Going through this process allows you to not only do your own personal planning, but the planning for all of your family at the same time, for kids, for grandkids, and how you want your estate to pass on, over what period of time. So we're going to jump into a quick case study. We're at 2:36. I think we're good on time. So Uptown Tool, John and Margaret Jansen are 64 and 62. They are married, and they built this business over the last 3 decades with John's father. They have 2 kids, Alex and Anna. Alex is in this business every day. Anna is not. And between the 2 kids, they have 5 grandchildren. So in meeting with John and Margaret, what we have come to learn is that they have received unsolicited offers for their business in the past. However, they're not really sure what it would be worth, and certainly not sure what it would be worth net of taxes and any fees. Um, the business doesn't have any debt in this case, but the son would like to own the business. They feel comfortable that he could run the business successfully, but that there are other key employees that could as well, if in some way he became disinterested. And they do not have an integrated plan. Personally, they'd like to stay close to these kids and grandchildren. They do want to travel. They want to volunteer at church and with some other organizations that they care about. They want to stay active and ensure their health. They don't want their health to eat away at their assets and impact their estate. They want to make sure the kids and grandkids are financially okay, but motivated. So they'd certainly like to leave them whatever's left, but they don't want to just, they don't want lazy kids or grandkids. They'd like to protect assets from in-laws. So this is not an uncommon situation where parents, business owners want their kids to benefit. They want their grandkids to benefit, but they want to make sure that that's the direct kind of transfer tree, if you will. So we talk about those things. On the financial side, they want to understand what the company's really worth. They want to do the retirement planning, think about protection strategies, deal with these estate planning and family dynamics issues. And then they have about a 3-year time horizon. They'd like to transition. They are definitely wanting to take advantage of some known growth opportunities before they transition out. They want to keep it in the family primarily, but they're open to understanding what the business would be worth if they did put it out there. And they have some employees that have been with them a really long time, and they really want to make sure they're taken care of. And there are different ways of doing that that we will speak with John and Margaret about. So with that, if you look below to the wealth planning discussions and analysis, several things we're going to cover with them and work with in concert with their other advisors. But I want to hit on just one out of each of these areas. The first is a very common situation. Again, Alex is in the business, Anna is not in the business. And we find that business owners are very much wanting to equalize between their children, even though one's not in the business. So, Will, when it comes to estate equalization, what are some of the things that we see happening?
Yeah, absolutely. And like you said, that's a very common thing. And I think it's important to note that equal and equitable are different things, right? So um, Alex is getting a business, but he's also getting a job. So the sense sometimes clients like to leave cash, for example, to Anna and then leave the business to Alex, where the business is profitable in the long run, could be making more money, but Alex is also getting a 9 to 5 with a business owner, typically much more than that. Um, but that's just one way. Life insurance, not in the traditional sense that we need it to replace income, but you use that as a pot of money on the other side for Anna. And also, there are ways to split voting and non-voting shares of the business. So Alex could retain control and voting shares of the business, while we could split off some shares for Anna that she could receive income from, but not necessarily have any say in the day-to-day workings of the business that would hamstring Alex from making the business successful.
Yep. So very interesting approaches to how we help try to equalize the situation. And then from the financial perspective, they are very tax sensitive. I hope we all are. And so they want to minimize the impact here from a tax perspective. And there are really two buckets that we always think about with clients. There's the income tax piece, year in and year out. How do you minimize that? But there's the income tax related to the sale of a business or the transition of a business. And feasibly, they may have an estate tax, maybe not today, but as their assets grow, they may have one in the future. So, will tax minimization, what do we look at?
Yeah, absolutely. So we'll start the income tax side. There are ways, different kind of charitable trusts you can set up, different kind of trusts in general, leaving shares to family members so that when the sale happens, you're not, as the owner, capturing that full weight of the income tax. So for example, you could carve off a portion of the business, put that in a charitable trust now. So when the business sells, those shares go to a charitable organization and you're able to take a tax deduction from that. lowering that tax liability a little bit. On the estate tax side, it's kind of a similar situation. We can start gifting shares to family members, business owners, other key employees, um, that will reduce your ownership in your estate value so that we can navigate and minimize any kind of future estate tax problem issue, and thus kind of freeze the value of the business, not in the sense on paper, but for estate tax reasons. We can freeze that value and help avoid any kind of large estate tax situation. We'll talk a little bit more about that shortly.
Yeah. And so for growing businesses, you can kind of freeze that, have the growth happen outside of your estate. Um, all kinds of interesting ways to minimize those impacts. And on the business side, as you can see here, we're going to do this informal valuation for them, the inside outside sale analysis. We'll do some debt modeling on the inside sale. What can the business handle if the business is going to have to support some type of loan? If Alex was to buy it, um, talk about opportunities to increase valuation, review next level management retention approaches, things like qualified plans, i.e. 401ks, benefits, non-qualified plans, phantom stock sometimes is used with certain employees. And then there are always these gifting and transition strategies. Anything, Will, that you would add to one of those buckets?
Yeah, I really like the next level management retention. Benefits are a strong reason. Let me rephrase that. It's becoming harder and harder to find good help, and find employees that'll work. And one strategy that we like to encourage clients with is either putting in a retirement plan, which can also have tax benefits as a business owner, but also maybe a situation where you've got some key employees that you want to make sure stay around for a long time. We can carve off a small portion of the shares of the business and award that to employees or let them buy into it, so they're participating in some of the upside of the growth of the business. So not necessarily enough to that they can help, or they can control or make changes, or do anything that goes against your mission as a business owner, but also allow them to have some skin in the game and participate in that upside of the business growth.
That's right. And sometimes we see our business owners just write checks to some folks, when that happens. Um, but it is very, very common that our business owners, are just good, kind-hearted people, and they really want to take care of folks that have helped them get where they've gotten. So it's always a topic of discussion that we work through in this process to make sure that those stakeholders are thought about. So with that, um, we're going to talk a little bit about the Tax Cut and Jobs Act sunsetting that's forthcoming, just so you all have awareness. And I'm going to turn it over to Will to cover some of these painful changes.
Yeah, this is the real dry stuff. So try to make this as intriguing as possible, because this first line I think is a very big change coming. So in 2017, the Trump administration passed the Tax Cut and Jobs Act, and that brought a whole slew of changes to the tax environment and legislation behind it. So at the end of 2026, that legislation is set to sunset or go away. So kind of the way we're looking at things is, no matter the outcome of the election, there's so much gridlock in the government that we don't project this legislation being replaced. So we're looking at the sunset as it's coming. So the biggest thing is, so currently this year, a single person has about $14 million in lifetime gifting or estate value before they run into gift tax. So for the married couple, that's almost $28 million before they have to consider paying gift tax. So the changes at the end of 2025, beginning of 2026, that number is going to be essentially cut in half. So a single individual will have about a $6 million unified credit, and a married couple will have about 12. So kind of what that means is, if you're a single person, you have your business that's worth 5 million, you have $1 million home, you're potentially looking at flirting with an estate tax issue at the end of your life. And the estate tax rate is 40%, and that's a flat fee. Some states actually have their own internal statewide estate taxes, North Carolina is not one of those states. There are several out there though. So you're looking at every dollar over that limit being taxed at 40%. So it's a pretty significant change that we want to make sure that we're looking at. And I strongly encourage everyone on this call, whether you work with us or not, to start having this conversation with your CPA to make sure that you're on top of these changes that are coming. So the personal income bracket, the top bracket, is currently at 37. It's going to jump back to close to 40%. The standard deduction is going to be cut pretty much in half. So that's going to go back down. This section 199A, which is the QBI qualified business income deduction, is going to expire, and that's a pretty large incentive for small business. So that's going to be a pretty drastic change. This one is a little bit of a better thing. The AMT alternative minimum tax is going to revert to lower levels. And then the SALT limitation that restricted local and state taxes to 10% is going to go away. And so that's actually another thing that is usually positive for business owners. But again, we'll see as the legislation changes. If I had a crystal ball, wouldn't be on this call today. So we have to kind of take this information with a grain of salt, but also know that this is how things are going to go if nothing happens. And Congress hasn't been doing a lot as of late. So again, we project this is what's going down the pipe. But like it says in the slide, there are some external factors. There is some big event that's a couple days away. I think people, I know in North Carolina, I'm tired of seeing the commercials, but it is an election year. A lot of these things are hot topics. We don't anticipate a real majority in Congress either way, which is ultimately who controls the way these tax changes happen. And the other thing is we do have a growing national debt. So tax cuts are going to be a hard sell because of that. Because at the end of the day, we've got to start paying this down because it's ballooning. I don't think there's any other way to say it. So
we got to grow. We got to grow our way out of it. Or drive revenues some other way. So
right.
You don't see it changing.
The biggest thing that I really encourage you guys to take a look at is when this estate tax exemption cuts, and if we're looking at this issue and it becomes a reality for you and your business and your family, is typically a lot of your net worth is tied up in your business, right? So frequently what happens when no planning is done is now all of a sudden this business has to be sold, and typically so the tax bill is due within 9 months. So any prospective buyers are going to know that you're under duress, and it's going to lower the value that you get in exchange for the sale of your business to your family. So this is really one of those planning topics that I feel strongly we really need to be on top of.
Yeah. So last comment here, and then we're going to jump is, again, you might not have an estate tax issue today, but as your assets continue to grow, you could have one in the future. And so we really just suggest, if we can help you do a review, understand where you are, help you know what the business is worth, project what your assets could be worth over time, and help you understand why you don't have one today, you might have one later. I think in your industry, you know that you're more likely to be able to insure yourself against future events and plan when you're younger, when you have more time. So it's always a good idea to get going on looking at these things. So I'm going to end today, before we go to a Q&A, with a little wisdom for success. I love quotes. So to begin with the end in mind means to start with a clear understanding of your destination, to know where you are now so that you're taking steps in the right direction. So that's all we're really trying to get our clients to think about, is how can we think with the end in mind and plan for that. And then the most successful companies over the long term are those who have rigorous succession planning initiatives. So again, we would encourage you guys all to think about this, and if we can be of assistance, we'd love to be. So with that, thank you. Paul, I'll turn it over to you.
Yeah, so if anyone has any questions they would like to ask, feel free to unmute yourselves to ask, or put it in the chat. Or if you would like to remain anonymous, if you want to put those into the Q&A, I'll just moderate them out to David and Will.
Yeah, and anything that you guys want to feed after the fact, feel free to. Paul, if you want to send us anything that we can answer afterward, we're happy to do that as well.
Absolutely.
Going once, going twice.
Okay, I do have a question, and the question is, I believe if First Citizens has any experience with creating a cooperative. I assume an
Like an
employee
ESOP?
cooperative.
Like an ESOP. Yeah. We do. I would say that it's closer to like an employee stock option plan, and they can be complex. And there's a very high administrative cost to them that can be ongoing. It really has to be the right fit for the right business. That's something that I mean we could talk about in depth for a long period of time. So I think it would be worth having a conversation, but that's certainly something that we have expertise in.
Yeah, that's one of those processes where if somebody really wants to try to transition internally and they'd like to consider the idea of an ESOP, it's just one of those analyses that we do. Our goal is to really understand what you want to accomplish, what motivates that, and then determine if that is the right strategy amongst others. Yeah. Great question.
Well, if nobody else has any questions, um, yes. Final question is if First Citizens is licensed for Wisconsin.
Sure, we actually,
I think we have some branches in
yeah, I
Wisconsin.
think we
Actually.
actually have some branches in Wisconsin, so yes.
So as we wrap up,
Really walk it, the good land.
there we go. So as we wrap up, I will send out David and Will's information to everyone who is on the call. So if you guys want to reach out, you can feel free to do that. I think we may also be planning a second webinar a little bit later this year, maybe early 2025. So if you do have any questions or any suggestions on topics to focus on for that, happy to take any of those suggestions. Otherwise, I think I can say thank you to David and to Will for coming here today. And thank you for everyone who joined us on the webinar today.
And Paul, I'd say if you guys send your contact information to Paul, we're happy to send you some further information on the Tax Cut and Jobs Act. There's a recent Supreme Court ruling on cross purchase agreements, i.e. buy sells, and how those are going to be treated and how you should look at them based on the Supreme Court ruling. And you can we can, you know, consider you for our weekly insights newsletter if that's something that you're interested in. So we really appreciate the opportunity to be in front of you today. And again, we'd love to help you if you feel like this is something you want to talk about and just get a better understanding of where you are. And we're happy to do that.
Absolutely.
Well, thank you, everyone. Have a good rest of your day.
Thank you.